Miss this week's moves, and you'll be trading last week's headlines. Welcome to Weekly Market Update, the cutting-edge podcast where two generative AIs, supervised by a former senior portfolio manager, break down global markets like no one else. We decode what matters: U.S. labor shock, Japan's next rate hike, China's stealth slowdown, so you can stay 3 steps ahead. This isn't just a recap, it's your edge. So if you like your insights sharp, timely, and way ahead of the news cycle, smash that like button, share this with your team, and hit subscribe. And don't wait. Listen to the full episode now, because by next week, it's already old news.
This week, it really brought some significant, maybe unexpected shifts across the global markets.
Definitely.
We saw investor optimism, put to the test, especially with some data points really reshaping expectations for what's next. Our mission, as always, is to cut through that noise, give you a precise, comprehensive look at what just happened, and, help you understand the path forward. We're talking about a surprising jobs report, a dramatic pivot in rate cut predictions, and some critical developments in key regions that you absolutely need to understand. Okay, let's unpack this.
Indeed. It was a week that reminded us just how swiftly market narratives can pivot. The complexity was undeniable. And what truly took center stage for investors, I think, was that rapid recalibration of central bank rate expectations. So our aim with this deep dive is really to provide you with the clarity and context needed to navigate these fast-evolving dynamics, hopefully with a bit more confidence.
Okay, let's begin with the United States, because that's where the big headlines were made, right?
Absolutely.
The S&P 500 closed up a modest 0.33% this week. The NASDAQ, often our growth barometer, climbed a bit stronger, 1.14%. A lot of that tech strength came from giants like Apple and Alphabet. They saw some relief after an antitrust ruling proved, far less disruptive than maybe feared.
Yeah, less severe than expected.
Exactly. The Dow Jones, though, was a slight laggard, dipping 0.32%. Interestingly, smaller and mid-cap stocks, which are often quite sensitive to interest rates, they also saw advances, got buoyed by falling Treasury yields and those shifting rate cut expectations. But the real story, the absolute game changer this week, was Friday's non-farm payrolls report. August added a mere 22,000 jobs.
Just tiny.
Tiny. To put that in perspective, forecasts were significantly higher. And in a stunning revision, June's figure was actually updated to reflect a net job loss.
Wow.
The first negative print we've seen since 2020. And the unemployment rate ticked up to 4.3%, its highest since 2021. This wasn't just a miss. It felt like a fundamental shift in the labor market narrative.
It really did.
Here's where the immediate market reaction becomes crucial. The jobs data triggered an immediate bond bounce.
Right.
Yields had been climbing earlier in the week, but they plunged after the Friday report. The 10-year Treasury yield, the benchmark for so many borrowing costs, dropped dramatically to 4.09% from a high of 4.31%.
Big move.
Huge move. Investors anticipating Fed easing just flocked to longer-term debt, driving those yields down. Futures markets responded almost instantly. They fully priced in a 25 basis point Fed cut on September 17th, and even assigned, a 14% chance of a more aggressive 50-point cut?
Yeah, the odds shifted fast.
The consensus view on Fed policy just flipped on a dime. And with that uncertainty and the quick pivot towards easing expectations, we saw a noticeable gold rush.
Yep, safe havens lit up.
Gold futures surged to an astonishing record high, $3,655 an ounce. It's up over 36% year to date. This tells you investors were clearly seeking safety, right? A hedge against potential economic softening.
Absolutely. Classic flight to quality.
Mortgage rates also felt the impact, falling sharply. The 30-year average dropped to 6.29%, the biggest one-day slide since August 2024. That's significant relief for anyone in the housing market.
A little bit of breathing room there.
Definitely. On the sector front, manufacturing continued its contraction 6 straight months. That's certainly still a concern for overall economic health. However, services managed to hold firm. ISM Services PMI climbed to 52%, indicating continued expansion in that crucial sector.
So still some resilience there.
Right. So a mixed picture overall, but that labor market weakness just dominated the headlines and totally reshaped rate expectations.
Yeah, and what's truly fascinating here is how quickly the market narrative pivoted. From cautious optimism just days ago to this strong conviction for Fed easing, driven almost entirely by that stark labor market weakness. But this rapid shift, it presents a critical dilemma for you as an investor. Are we seeing a market primarily betting on Fed support just to prop up asset prices? Or Are we acknowledging a more uncomfortable truth that maybe monetary easing is coming too late? Or it's simply not enough to counter a deeper issue of slowing economic growth?
That's a really important distinction.
It is. It's a crucial distinction for your long-term outlook, thinking about where things are really heading.
That is a vital question, highlighting the underlying tensions. And these tensions aren't just in the U.S. Similar dynamics are playing out as we look across the Atlantic to the Eurozone.
Right. Europe's got its own complexities.
For European equities had a tougher week overall. The stock XX, Europe 600, down 0.17%. Germany's DAX lost 1.28%. France's CAC 40 slipped 0.38%. The UK's FTSE 100 was a slight outlier, actually gained 0.23%. But the dip across most of Europe was largely driven by those broader global growth concerns we just discussed.
Yep, the spillover.
Combined with a stronger euro, which can be a headwind for European exporters. Germany and Italy, two of the continent's largest economies, led those declines. On the inflation front, the picture was, well, somewhat stable. Eurozone inflation ticked up slightly to 2.1%. That's quite close to the European Central Bank's 2% target.
Getting there.
Core inflation, which strips out the volatile stuff, remained steady at 2.3%. And we saw services price pressures ease just ever so slightly. So progress on the inflation fight seems to be holding, at least for now.
Yeah, the trend seems okay there.
Looking at labor and retail data, there was a bit of a mixed signal. Unemployment actually edged down to 6.2%, showing some resilience in the labor market there. However, retail sales fell 0.5% in July, and that certainly raises some concerns about consumer strength, especially as we head into the back half of the year.
Yeah, the consumer is key everywhere.
Definitely. For the ECB outlook, policymakers have been signaling a pause in easing, citing that more stable inflation backdrop. So the market expectation going into Thursday's ECB meeting is that they will hold rates steady. Just take a moment to assess the impact of previous moves.
Right. And if we zoom out and connect this to the bigger picture, the Eurozone presents a truly nuanced situation for investors. While inflation is indeed nearing its target, which suggests the ECB's previous actions are working, the underlying growth concerns and that softening demand in areas like retail sales could easily reignite the debate about further easing, maybe in Q4.
So the pause might not last.
Okay, exactly. The critical challenge this presents for you is understanding if the ECB's anticipated pause signals genuine confidence that they've done enough. Or if it's more of a reluctant holding pattern, amidst these tepid economic signals and maybe a desire to avoid an overt recession.
Right.
The subtle language from the ECB, from Lagarde, will be absolutely key this week, reading between the lines.
Sticking with Europe, let's turn our attention to the UK. The FTSE 100, as we mentioned, gained a modest 0.23%. But the broader market really felt like it was treading water this week. This was largely due to a mixed bag of housing data and some rather cautious commentary coming out of the Bank of England.
Yeah, the BOE is definitely sounding cautious.
On the housing front, it was truly mixed. Mortgage approvals actually rose, suggesting some life in the market there. However, house prices showed divergence. Nationwide's index slipped 0.1%, while Halifax recorded a small 0.3% gain. So no clear direction, adding to the uncertainty for homeowners and buyers.
Yeah, very patchy signals there.
And the messaging from the Bank of England was particularly noteworthy. Governor Bailey warned of considerable doubt around further rate cuts.
Strong words.
He cited rising inflation risks and persistent labor market concerns. Adding to that hawkish tone, Deputy Governor Lombardelli hinted that the terminal rate where rates might peak may remain near 4%.
So not expecting cuts anytime soon then.
Doesn't sound like it. Suggests the BOE is far from declaring victory on inflation, even as growth seems to be faltering.
Well, what's fascinating here is the Bank of England's precarious tightrope walk. They're likely on pause, yes, but the fragility in the housing market, coupled with those persistent inflation fears, creates an incredibly challenging environment.
Yeah, tough spot.
The divergence in housing data perfectly illustrates just how sensitive the UK economy is to interest rates right now. So for you, the fundamental dilemma becomes, how will the BOE truly balance these sticky inflation concerns with the potential for further economic softening? Especially if the housing market continues to show this kind of uneven performance, their next moves will be absolutely critical for the UK economy.
Okay, moving over to Asia, let's talk about Japan. Japanese equities had a strong week. Nikkei 225 up 0.70%, Tito PX gained 0.98%.
Some positive momentum there.
Yeah, this boost was largely supported by two key factors: a finalized U.S.-Japan trade agreement and some surprisingly strong wage growth data.
Ah, the wage growth, yes.
That trade tailwind was a significant positive.
Sure.
The new U.S.-Japan deal capped auto tariffs at 15%, secured major Japanese investment in the U.S., which naturally gave a substantial boost to auto shares, a critical sector for Japan.
Good news for exporters.
Definitely.
Yeah.
But all eyes are now on the Bank of Japan because the wage data was truly eye-opening. Wages surged 4.1% year-over-year in July.
That's a big number for Japan.
Huge. And for the first time this year, real wage growth actually turned positive. That's a massive deal for an economy that's battled deflation for so long.
Finally, some purchasing power increase.
Right. BOJ officials have continued laying groundwork for a potential rate hike in October, even though underlying inflation is still technically below their target. That wage growth is pushing them.
Yeah, it gives them cover, potentially.
However, not all news was positive. The yen continued to weaken, falling to JPY 148 per US dollar.
Still under pressure.
Yeah, largely pressured by those persistent interest rate differentials compared to other major economies, and maybe some political uncertainty surrounding Prime Minister Shigeru Ishiba also played a role.
Right. And if we connect this to the bigger picture, Japan is experiencing a potent mix of, well, good news and underlying risks right now. The strong wage growth certainly provides the Bank of Japan with more justification to consider a rate hike, a move that would mark a really significant shift in their long-standing monetary policy.
A historic shift, potentially.
Potentially. But this prompts us to ask, can the BOJ effectively navigate the existing political risks and the ongoing currency volatility, especially with the yen already under pressure? Can they execute a hike without destabilizing other parts of the economy or upsetting global capital flows? It's a really delicate balance that impacts global markets significantly.
Very delicate indeed. Okay, our final stop on this global tour is China. Mainland market saw some declines this week. CSI 300 down 0.81%, Shanghai Composite fell 1.18%. The Hang Seng in Hong Kong, interestingly, bucked the trend, gaining 1.36%.
Divergence there, too.
Yeah. This rally on the mainland fizzled out after quite a significant summer surge. The CSI 300, for example, had surged 10% in August.
Big run-up.
But then it pulled back as investors started to book profits. We also saw margin debt hit record highs, indicating potentially overheated retail sentiment. That often signals speculative activity rather than fundamental strength. Right?
Yeah, frothiness, perhaps. A warning sign sometimes.
Definitely. Despite some optimism around AI and government campaigns to address overcapacity in certain industries, the real economy signals continue to remain weak. Deflationary pressures persist. The crucial property sector continues to drag heavily on economic activity, impacting everything from consumer confidence to local government finances.
It's a major headwind.
And of course, the looming threat of U.S. tariffs remains a significant concern. It's a tough environment for Beijing to manage.
Well, what's truly striking here is the stark contrast between that market momentum we saw and the underlying economic realities in China. The summer surge, largely fueled by domestic liquidity and maybe speculative fervor, really shows the power of sentiment in driving short-term gains. But this raises an important question for you. Without stronger macroeconomic data to really underpin it, or decisive large-scale fiscal action from Beijing, how quickly could this market momentum just fade away?
Yeah, can it last?
Exactly. And what are the global implications if China's deflationary pressures deepen further? Could they export disinflationary forces worldwide? It's a very fragile situation that we all need to watch very closely.
Those are powerful insights into the current state of play. Now, let's turn our attention to what's coming up next week, September 8th to 12th, 2025. These are the critical economic releases that will undoubtedly shape market sentiment and influence your decisions. So what does this all mean for you as we look ahead?
Okay, let's line them up.
For the United States, on Monday, we have consumer credit data. Tuesday brings the NFIB Small Business Optimism Index, giving us a pulse on small businesses. Wednesday, we'll see the Producer Price Index, PPI, along with wholesale inventories. And then the big one for Thursday, the Consumer Price Index, CPI.
That's the main event.
Absolutely. Key Federal Reserve input, markets will be hanging on every digit. Friday rounds out the week with the preliminary University of Michigan Consumer Sentiment Report. In the Eurozone, all eyes will be on Thursday for the ECB rate decision, the deposit facility rate announcement, and the all-important ECB press conference with President Lagarde.
Key communication point there.
For the United Kingdom, Friday brings us the UK GDP month-over-month figure for July. gives us an updated snapshot of their economic growth or lack thereof.
Mm-hmm.
And in China, Monday will release the trade balance along with imports and exports data for August. Then on Wednesday, we'll get the inflation rate year over year for August.
Right. These aren't just dates on a calendar. They are potential turning points for market direction. As we look ahead, here's what to watch specifically. First, the U.S. CPI showdown on Thursday is paramount. A hotter-than-expected print could significantly delay those rate cuts, potentially reversing some of the optimism we saw this week.
Right.
While a cooler one might just seal the deal for the Fed to ease in September. It's that crucial.
Huge implication.
Then, the ECB's tone on Thursday will be critical. Will President Lagarde confirm a definitive pause, or will she leave the door ajar for more moves later? The nuance matters. Finally, China's inflation data on Wednesday. This is important because negative CPI would renew those deflation fears and put immense pressure on Beijing for more aggressive stimulus.
Okay.
Understanding these specific events helps you anticipate the ripple effects across different asset classes and prepare accordingly.
That's a fantastic overview of what to expect. And speaking of preparation, let's distill this even further. We've identified the top 5 risks to watch for the coming week and maybe beyond. These are critical elements for you, our listener, to monitor closely.
Absolutely. Staying ahead of these potential shifts is really key to informed decision-making. Okay, risk 1. U.S. CPI surprise. Why it matters. It's the last major inflation input before the Fed's rate decision just a week later.
Crucial timing.
Exactly. The specific risk is that a hotter-than-expected print could absolutely derail those rate cut expectations we just talked about. It could spark a significant bond sell-off and reverse recent gains in equities and gold.
Okay.
So, mark your calendars. Thursday, September 11th, U.S. Consumer Price Index.
Got it. Risk number 2.
Risk 2, ECB communication misfire. Markets broadly expect the ECB to hold rates this week, but clarity on their path forward is still, well, murky. The specific risk is that a hawkish tone or even just weak forward guidance could easily unsettle Eurozone assets, especially given those fragile consumer and retail data points we discussed earlier.
Mm-hmm.
This all unfolds on Thursday, September 11th with the ECB rate decision and press conference. Watch Lagarde's language carefully.
Number 3.
Risk 3. China deflation deepens. Despite recent market gains, China's real economy is still very much under pressure. If the CPI turns negative again on Wednesday, September 10th, confidence in any kind of recovery could quickly unravel.
Yeah, that would be bad news.
It would. This renewed deflation would push Beijing towards more aggressive stimulus, but any delay in that action, or if it's seen as insufficient, could rattle global commodities and emerging market assets, impacting your portfolio.
Right. Risk 4.
Risk 4. UK growth falters. The Bank of England is holding firm on rates, as we discussed, but the upcoming GDP data could show the economy stagnating or even contracting. The specific risk here is that weak growth combined with that sticky inflation would strongly reinforce stagflation fears. It would significantly complicate policy decisions for the BOE heading into Q4, potentially impacting sterling and UK equities.
And when's that data out?
Watch for Friday, September 12th, for that UK GDP month-over-month release for July.
Okay, and the final risk.
And finally, risk 5, surging global bond yields. This is more of an ongoing concern, but it's really important. Volatility in long-term government bond markets, particularly in the UK, their gilts, and Japan JGBs is raising red flags globally.
We've seen some jumps recently.
Exactly. The specific risk is that sustained increases in these long yields could tighten financial conditions worldwide, almost like a central bank hike. It could undermine already fragile housing markets and hit risk assets broadly, especially if inflation surprises force a policy rethink somewhere like the US or UK. So keep a close eye on 30-year gilt and JGB yields for those stress signals.
That's a powerful and really actionable set of risks to keep front of mind. So to grind it all together, we've seen markets in a real tug-of-war this week, haven't we? Caught between slowing growth signals and the growing anticipation of central bank easing.
Real push and pull.
That unexpected U.S. jobs data absolutely tilted the scales towards easing, but genuine concerns about underlying economic momentum definitely persist. As we head into next week, the upcoming U.S. CPI report and that ECB meeting will be absolutely pivotal in shaping the entire September market narrative.
Absolutely. And, as we consider these complex dynamics, maybe the overarching question for you to ponder is this. In a world increasingly shaped by central bank reactions to incoming data, what if the market's current fixation on immediate rate cuts overlooks a more fundamental and perhaps longer-term shift in global economic growth? And if that's the case, how might that challenge conventional investment strategies and maybe some long-held assumptions moving forward? something to think about.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.